Hello, everyone. Ladies and gentlemen, thank you very much for coming for the second event of our MeDirect Talk series. After the successful launch last March with the presentation by Terry Smith from Fundsmith, today MeDirect would like to give a big welcome to David and Donald. David Roberts and Donald Phillips from Liontrust Partners, two very well-known fund managers, particularly in the fixed income category. Also would like to welcome Mr. James Bedell, who is the head of international sales from Liontrust as well. And David and Donald will be giving us an overview of the current markets, as well as an update on the high-yield bond fund, which was successfully launched by Liontrust in June 2018. They'll also have a look at what may lie ahead in the future for the fixed income market. At the end of the presentation, David and Donald will be able also to take some of our questions. So the floor over to you, gentlemen.
So firstly, thank you for coming, and secondly, thank you for your kind applause. I wonder if you will applaud as loudly when I leave the stage as when I arrived on it. I'm going to spend a few minutes talking about, well, really kind of global economics, but without going into too much detail. And then I'll pass over to my colleague Donald, who will spend a little bit more time perhaps talking about the detail of the high-yield market specifically. I've been fortunate enough for business reasons to be coming to Malta since about 2007, and just like to say thank you for the warm welcome I've received pretty much every time I've been here, and then also from a business perspective, importantly, for the support that the Maltese people have shown to funds that I've been involved with. So I say I'm going to just talk for a few moments about the global bond market. If I can get the, where we go? Here we go. So I suppose the first thing I should say, if you're having difficulty understanding me, I do apologize. I am Scottish, so perhaps like many people in the room, English is my second language. But I will do my best, as I say, hopefully to be understood. Now, normally when someone stands up and claims to be a specialist in an area, and I claim some specialism in bonds, they then start to say how attractive the opportunity is and sell something. But to be very honest, the problem I have doing that today is that bond markets are incredibly expensive, and if we are not careful, are also incredibly dangerous and risky places for the investor. So you will see a few statistics perhaps as I talk, which suggest that. That doesn't mean that there are no opportunities to make some money or to protect money. But as I say, my part of this presentation will focus more on economics, and perhaps in the question and answer session, we could spend a little bit of time talking about how we seek to protect cash in the bad times, but still create some opportunities in the good. So, I think the first thing to talk about is that today, perhaps because of the pace at which we're living, because of social media, because of people such as Donald Trump sending messages out every 30 seconds, we have this fear that everything is really bad. We hear from people like Mario Draghi at the ECB, or the head of the Japanese central bank or the American central bank, how difficult times are. And we read the headlines in our newspaper saying that global growth is being downgraded and how difficult things are likely to be after 11 years of constant economic expansion. So this slide, which I presented, shows the latest forecasts from some of the world's leading authorities in terms of growth. for the world this year and next. So we know the economic cycle is old, and we know that trade issues and concerns about the relationship between America and China, between America and Europe, well, between America and everyone, are becoming a little bit more difficult and causing investors some concern. But beyond that, partly because of the strength of the consumer, growth is generally okay. And those numbers, those forecasts for real growth, so that's after inflation, and then nominal growth from the IMF, the World Bank, and the OECD suggest that although the global economy is slowing a little bit, the outlook is not as bad as we sometimes read in our newspapers or on Twitter or Facebook. So why is that the case? Why is it after about 11 years things seem to be quite positive? I mentioned the consumer, and we do need to remember when we are making forecasts about economic activity how important the consumer is. In America, for example, the consumer accounts for nearly 70% of the economy. And as this slide shows, wages in America have been growing quite rapidly and significantly above the rate of inflation. And that means simply from wage income, the American consumer this year has nearly $380 billion more income before tax than they had a year ago. And if you add on to that number wealth effects from rising property, from equities, from bond prices, from distributions and dividends, that number moves well above $500 billion. So that's just America. That's an economy which we know, compared with Europe, compared with the UK, compared with Japan, has been doing quite well. But still, it gives us some hope that unless consumer confidence collapses, unless the current issues around trade and negativity start to really affect consumer confidence, there is some hope that those of us running businesses, those of us investing in certain parts of the market, perhaps don't need to worry as much as some other experts are suggesting. The other side of the equation for me as a bond manager is considering inflation. Now, inflation, as I'm sure most people in this room will know, is very bad and eats into the income that we receive from many of our assets. Again, there is a rumor in the market that inflation is dead and will never return, and as a result, we can continue to buy assets with very low yields and not worry about that corrosive impact of inflation. So this chart, again, quite simply shows inflation as measured by CPI going back about 30 years. And with the exception of the spike in the early 1990s, you can see, firstly, that series is quite volatile, but secondly, today's numbers are by no means out of line with historic averages, and certainly not back to the levels that we saw in 2008 associated with the global financial crisis, or in 2014 and 15 associated with the energy and then the euro crisis. So for those who are investing in assets such as bonds that pay a fixed coupon, it's very important to realize that despite what many people are saying, inflation does exist and can eat into some of that diminishing supply of income. Now, the other thing to say is that when we're thinking about investing in markets, it's really important, I think, in any asset class. It doesn't matter what you buy, whether it's a house, a car, an equity, or a bond. What's hugely important is to think about the starting point. Now, I think that's quite obvious, but sometimes it just perhaps bears repeating. If we think it's not that long ago that yields on core markets, whether those are Italy, the United States, or Germany, the yield that we could receive buying into our local government bonds, Malta no exception, was above 4%. In my domestic market of the UK, we were receiving more than 5% to lend to the UK government each year for 10 years. Then fast forward to today, well, actually September 2018, first of all. So in September 2018, yields had started to rise a little bit because people were worried that central banks would increase rates. But from that time on, there's been a panic among central bankers that investors would flee from assets because they were going to see interest rates go up. And the impact of that for us as bond managers and perhaps as bond investors has been fantastic. We have all pretty much seen significant capital gain, whether we buy high-yield funds, strategic funds, investment-grade funds, or again invest direct into government debt. The problem, though, with that is for those who are buying the market today, who have income or capital to invest, the yield, the return that we are likely to generate is incredibly low. And those figures at September 2019 are very, very close to the lows that we have seen in the history of the bond market. Now, if you remember that previous chart I showed, it was showing a 30-year history. For the bond market in certain parts of Europe, we can trace history back 500 years. And never during that time have yields been as low as they are in many major markets today. So, again, I know as a bond manager I'm supposed to stand here and say, please buy my fund. It can only go up, you'll make money. But the statistics say that we have to be very careful if we are risking investing in this type of market. And bear in mind, despite what everyone said, growth and inflation are actually okay. So, this is just looking at in a similar way. If we think about one of the reasons why we buy bonds to generate income, one of our starting points over the longer term is not to see our income eroded because of inflation. As I say, over the past 500 years, almost always when we buy bonds, we have received more from the person we are lending to than inflation. In the last 3 or 4 years, that has changed. So again, as I'm sure many of you know, lending direct to the Maltese government, lending to many of the corporates in core Europe or even in America, guarantees a return that is lower than current inflation and way below what inflation has averaged over the last 20 or 30 years. And we know why. We know why because central banks tell us that they are manipulating the markets, that they are pushing yields down. Great for those of us who have been invested and we have some nice capital gain if we can find something else to do with the money. Of course, the problem is today all assets look very expensive. So selling one expensive thing perhaps gives you no option but to buy another expensive thing. One thing, I've mentioned the word expensive 2 or 3 times. Sometimes it's okay to buy things that are expensive. If you don't believe there's any risk in something that's very expensive, perhaps it's worth investing. The problem when we buy bonds today is that governments and companies are not stupid. They recognize that interest rates are as low as they ever have been. I'll give you an example. So Goldman Sachs, the American bank, which has had its troubles over the past few decades, was able to issue a bond in Europe, paying investors 0.125%. This is not a government. This is not a well-known corporate. This is an investment bank. Also, they issued that bond for 15 years. The problem with the bond market today is, firstly, it's expensive, but secondly, it is also very, very risky. And what this chart highlights is the extent to which the risk in the market has changed over the past 2 decades, or certainly the last decade when central banks have started to manipulate it. So we use this measure of risk in the market called duration. And it doesn't really matter too much what it means. It's simply a measure of how much risk investors are taking when they buy the average bond. Now, a decade ago, the average bond had a risk score, a duration of about 4.5. Today, that risk measure is up to about 7.5. So that means the average bond in the market is close to twice as risky as it was a decade ago. So if you think about it, we've got a market that is incredibly expensive and also on this single measure is more risky, more volatile, where your capital is more at risk in the short term than has ever been the case. So when people talk about, oh, maybe there's an ETF somewhere, or here's a directional bond fund, or you should take this, buy Austrian bonds because they only ever go up, and look, they made 30% year to date. It is very important to realize that the market that they're selling you is as risky and as expensive as it ever has been. So one thing people would say at that point is, but bonds are still a store of value. I know I can lock them away for 5 years or 10 years, take a little bit of income, and at the end of that period, everything will be all right. The problem, though, again, and apologies, maybe the text is a little bit small. If we think about this, so we'll use Germany because it's quite an extreme example. Every year, at the moment, we lend to the German government, we lose more than 0.5% of our wealth, in nominal terms, right? So over 10 years, we would have lost 6%. That's guaranteed. You give the German government €100 today, in 6 years' time, if you own the bonds, you will get €94 back, effectively. Right? That's nominal. But if you then adjust that for inflation, bearing in mind German inflation is supposed to be really, really low just now, then that means in real terms the money you are lending to the Germans today will be worth 20% less when you come to redeem it, to reinvest it in a decade's time. At the other side, I thought I would use Italy. So Italy is one of the few examples where there is a very small positive return. But if you look at that, so if we know the issues around Italy, it's perhaps a slightly volatile economy, some would say. Lend to the Italian government today, and in real terms, you make about 3% over the next 10 years, assuming, again, inflation doesn't rise from their current incredibly low levels. So bond markets are very expensive. Bond markets are very risky. And whilst countries such as Germany and Italy might not default, if you are concerned about getting your money back in real terms, about not losing value compared perhaps with other people or broader society, they just don't make sense. So, as I say, that's a kind of quick chat about global bond markets. Just to summarize before I pass over to Donald, so the global economy is actually okay and is forecast to continue to be okay over the course of the next 1 to 2 years. Yes, that can change, but already in those forecasts is some information for a slowdown associated with Mr. Trump and trade problems. The standard way of looking at bonds makes them look very, very expensive. They pay little or no income. In some cases, the income is negative, as we know. And importantly, they also offer, in my opinion, very poor value protection in the medium to long term. The core of the market, so high-quality bonds issued by governments and companies, is more risky than ever. And we've seen that, again, I mentioned Austria, but many companies as well as countries issuing bonds with 100 years maturity, where the slightest little ripple in the market can push the price up 10% or down 15%. So core bonds, these markets that most people have invested in for decades, are very, very expensive. Is there a recession coming? Well, it's a probability, but the problem with that for those who are looking to save their money in bonds is already the price in the market is pricing one of these black swan global financial crisis type events. So our view is that for income and total return, it is difficult for me as a bond manager to recommend what we would describe as directional funds, funds that go up when the market goes up and fall when the market falls, rate-sensitive bonds and bond funds. As I say, perhaps we have some time in our Q&A to talk about why funds such as the strategic fund I run has delivered 7 or 8% this year in Europe without taking too much risk. But really, I think for now, to talk about a fund and a market which offers, we think, some quite good protection still, I'll pass over to my colleague Donald to talk about the high yield market.
So I am also Scottish, but I'm the slightly more positive one out of the two of us. Now, David has spoken eloquently about the fixed income asset class. But the beauty of high-yield bonds, the way I see it, it's more of a cousin of equities. It's about the quality of the companies you invest in rather than rate sensitivities and what central bankers are up to and all these different issues that David spoke of. And that's why we are, right now, more positive on the outlook and the characteristics of the high-yield market than the fixed income market in general. And let me talk a little bit about some of those characteristics in my presentation. So, maybe not so much in Malta. I think you guys over here understand what the high-yield market is and what it does and its characteristics. I think you understand it quite well from my experience. But that is not so true, say, for example, in the UK. It annoys me as a high-yield manager to pick up that lovely pink newspaper, the Financial Times, every other day and read a negative article about the high-yield market. It took me about 5 minutes to Google these headlines, constantly talking about junk, which is a nickname from the 1980s, talking about stress and distress and illiquidity, and constantly driving a negative perception of high yield as an asset class that I frankly just don't recognize. So, for example, in our fund, our global high yield fund, we have a strong preference for good quality companies that in fact are stock market listed, transparent, highly liquid, stock market listed companies instead of private companies that only tell you what you need to know. You've seen all the WeWork stuff in the press recently. WeWork were making things up in their numbers and they got caught out and they had to take their IPO back. We like high quality businesses, and 85% of our high yield fund is in stock market listed businesses, and I'll challenge any high yield manager in the market to have a higher number than that. Now, of the companies that are listed in our portfolio, the average market capitalization is $24 billion. When we ran these numbers in the summer, that was the same average size of the FTSE 100 companies. Now, I can tell you, in the UK, the FT is not writing a negative article every 2 days about describing the FTSE 100 as junk. No junk in our portfolio, thank you very much. So maybe one of the reasons why high yield becomes a bit of an easy target is the phenomenon of defaults, which become this really scary word. What do you think defaults are going to do in the next 12 months is a question I get asked all the time. I don't have a crystal ball. I suspect they'll probably go higher given the economy seems to be slowing in general. But you can see these periods in the past where defaults have spiked up quite significantly. I think this phenomenon, at the same time this has happened, equity markets have fallen 20%, maybe more. But for some reason, people focus on this phenomenon of defaults. And I think that's what makes the high yield market a little bit scary to some, maybe not so much in Malta. But if we think about high yield as an asset class, here we have a chart showing the total return of the high yield market going back to 1998. That's the upper line. And we have only the price return. So if you take all of the income away, take all the interest payments that companies make, the lower line is just the price return. You can see that for the last 20, 30 years, price returns have gradually declined. That's defaults. There's just that natural level of companies that fail. That's capitalism. It's not great when people lose their jobs, but it doesn't mean it's a reason for people to be scared of the high yield market. Now, the much more pleasant line is the total return. Now, I'm not just showing you long-term total return for the high yield market. I want to focus in on a specific period. You'll remember from the previous chart, look at the big heart attack default spike in 2008-9. Most of you remember that capitalism nearly crumbled before us in the later stages of 2008. So what happened if you decided to invest in the high yield market in mid-2008? Let's just say June the 30th, 2008, you decided to put your child's inheritance into the high yield market. Well, within 12 months and 23 days, you were back in the black. You were back in positive territory for investing in the high yield market, despite defaults, in the worst financial crisis we've had in 70, 80 years. Now, I actually bought my first property in central Edinburgh around about the same time. It was not back in the black within 12 months and 23 days. Actually took more like 10 years. And I can say that the Edinburgh property market's a lot healthier than the Glasgow property market, which is a dig at my colleague who's from Glasgow. I apologise. But we see high yield as an attractive, long-term, income-generating asset class where the volatility should not be feared. When you have a default period, uncertainty hits the market and valuations improve. Yields recalibrate and replenish at a higher level. More companies issue bonds at that higher level, and the asset class continues to survive. If you'd invested on June the 30th, 2008, a time we can all agree could be described as bad timing, we would sit here today in euros having earned more than 10% per annum over 11 years. Now, you can see the periods where we've had a drawdown on the asset class, periods of volatility. A good manager with flexibility in their fund can reduce risk at opportune moments in the portfolio and increase risk at opportune points in the portfolio to try and add what we horribly describe in our industry as alpha, whatever the hell that means, but it's just adding value, justifying the fees that we charge. Good managers can take advantage of moments, and we try to do that in our portfolio. So here we have today where we are right now in terms of yields. Now, I'm going to show you a chart that might frustrate you as investors in this part of the world. The top line is the US high yield market. Today it yields around about 6%. 6% sounds fantastic in Europe, doesn't it? The European high yield market is the lower line. Today yielding around about 3%. Sounds more familiar, doesn't it? Our portfolio much prefers US-denominated high-yield bonds, but we're not earning 6% for you. Because of low interest rates in Europe compared to the US, and you have to translate the currency, it all comes out in the wash. And in Europe, you earn a similar amount for investing in US high-yield than you do European high-yield. However, we're portfolio managers. We're also seeking diversification and to reduce risk. And we think the opportunity and the quality of companies in the US high-yield market compared to the European high-yield market is better. And we far prefer investing our clients' money in the large, liquid, high-quality US high-yield market. That's why we've got such a high proportion of listed businesses with good, big, old, strong market capitalization. So, moving on to our fund. Slightly boring looking slide, but just the facts. It's managed by myself and Phil Milburn primarily, although, as mentioned, we do consider the wider economic environment, which is David's main role in the fund. We launched the fund with your support, with the support of our friends and colleagues in the front row and yourselves on 8th of June last year. And our primary objective is to provide our clients or maximize total returns over the long term. By long term, I'm talking 3 to 5 years, through a combination of income and capital growth. And our other objective, which we don't put on the boilerplate, is that we're trying to outperform passive options. Now, if that's jargon, I apologize, but in the investment industry at the moment, the growth of passive funds has been huge. Apparently low cost, non-selective over what they're investing in, just investing in everything to provide you a general return associated with the asset class. We are trying to outperform these passive options in the high yield market by 1.5% per annum over the long term after our fee, thereby justifying the fees that you charge in active management, although actually our fee and the passive fee is pretty similar. So further, I don't understand the desire to invest passively in the high yield market, and I'll come on to that. So, the Liontrust high yield bond, process and philosophy. Usually managers don't really talk about their process and philosophy in big rooms like this because it can get quite a boring topic. But we can make ours really simple. We are focusing on micro factors, i.e. factors specific to the company, not factors specific to the general economy. With a concentrated, what does that mean? We have a relatively small number of companies in our portfolio compared to our competitors. We focus really, really hard on a small subset of companies, good quality companies, and focus all our attention and a large proportion of the weight of the portfolio in those better quality companies. Part of the quality that we're looking for is a good balance of interest between the owners and managers of a business and its creditors. Too many instances where companies borrow a lot of money and put that money in their own pocket and then hope to refinance that in 5 years' time. Famously happened with Manchester United, the football club in the UK. American owners came along, borrowed money to buy the club, paid money to themselves, paid a dividend on day one, and then hoped that the business would just pay its interest and refinance itself in the future. I think that is a bad balance of interest between all the stakeholders in the business. We want to understand that the motivations of management and owners do not provide a conflict of interest with the creditors of a business. As I've mentioned, macro thinking hopefully will add value to our process through the cycle. We can increase and decrease risk in our fund when we feel that the macro environment and the valuation opportunity is justified to do so. And at the moment, 2019 has been a very strong year. At the start of the year, valuations were fantastic. After the sell-off in Christmas, we increased risk. And all year the markets rallied, we've been decreasing risk. The worse valuations get, the less likely we are to reach for yield. The more you reach, a yield is a theory. When people punch a yield calculation into their calculator, you assume that you're getting your money back at the end. Too many people talk about yield and tell you they can achieve a certain yield when the risks that they're taking it to do it will not guarantee you getting the money back at the end of that investment. Our philosophy, true diversity comes from idiosyncratic stock picking. So many high yield funds out there will have 300 bonds in their portfolio. And the manager will say, well, I've got 0.3% in, every bond out there. So if one of those companies goes wrong, who cares? It's only 0.3% of the portfolio. They think that provides true diversification. We strongly disagree. We think that leads you to accumulations of thematic risk like in oil and gas and these big cyclical and dangerous industries. We much prefer diversity from the idiosyncratic. So this just looks like a big table from where you're sitting, I'm sure. So probably not coming out well in the room, but really that's just showing you the sectors that are available to us to invest in. Those sectors that we would describe as thematic, so oil and gas, the oil price will impact all the companies in that sector pretty much the same way. That's very thematic. It's very cyclical. That is a lethal combination when you have a whole load of money you need to pay back in 3 or 4 years' time. And you'll see that the proportion of the portfolio we have in thematic and cyclical sectors is very low, whereas in idiosyncratic, non-cyclical, cyclical just means what the economy is doing, you'll see a much higher proportion of our portfolio in idiosyncratic, non-cyclical. And in those companies where we see an idiosyncrasy and not tied to the health of the economy, we will own 2 or 3% of your funds in that individual position. So stock picking and what you own is all that matters, and what the oil price is doing on a daily basis, who cares? So one of the examples of a company that's in our portfolio, you'll see, if you could have read this, you would see that media is our largest sector. Now, I describe media as mixed in terms of cyclicality. I keep hitting this. Some media companies are very much linked to advertising. Facebook, a commercial television channel that still shows adverts like ITV in the UK, tied to advertising, therefore tied to the business cycle, volatile earnings. Netflix, probably most of you use the service, or someone in your family used the service, no adverts, no cyclicality. It's a hugely valuable company. Its market capitalization, last time I checked, was $120 billion. It's 140 million plus global subscribers to its service. That huge subscriber base allows them to spend lots of money on content, producing TV shows for us all to watch going forward. Now, the biggest risk to this company, and it's quite popular in the press at the moment, is competition. Particularly in recent weeks, Apple announced that they were launching their Apple Plus service, where they're going to charge people $5 to watch stuff on their service. Netflix charges $10. So a lot of concern. Problem is, Netflix doesn't have any content to show people. Sorry, thank you, James. Apple doesn't have content to show people. They're going to have to do something about that. And there's going to be a big race to the bottom, if you like, in terms of fighting each other to build content. But I think Netflix is far along enough in that process that they're going to be around in 10 years' time. Its bonds pay investors in our portfolio a spread. So a spread is the premium on top of a government bond of 4%. Now, I think, don't tell me, come back to me in 1 year's time if it hasn't happened yet, I think Apple are going to buy Netflix. It's not a commonly held view. Netflix will be fine on its own. If Apple were to buy Netflix, that would be a 25% return on this bond. 25% is a fantastic return on one individual bond, especially a bond that's as high quality as Netflix. On to motivations just at the end. I talked about motivations being a big part of our process. The Netflix founder still runs this company. I think that's quite an important attribute to think about, because if a business has been owned by 4 or 5 different private equity owners, where's their love for this company evaporated? This guy has skin in the game, as we describe it, and a motivation to see this business is going from strength to strength in the next 10 years. So the bit that Scottish people don't like talking about, because we are self-deprecating by nature, is the performance of our high yield fund. I'll maybe start on the slide that shows the performance of the Euro share class, which most of you would be most interested in investing in. So since we launched in June 2018, the fund to the end of August, after fees, has outperformed the index by 1.2%. Since August, we've done even better. So we are adding value on top of the, frankly, low yields that, you know, the headline yield is not that exciting, but we are adding value in this market on top of that, after fees, and beating an index. But as I mentioned at the outset, passive funds are becoming all the more attractive to investors. And passive funds in the high yield market have done a terrible job at trying to replicate the performance of an index, although they only really write that in the very small print of their marketing documents. So passive funds have traditionally significantly underperformed normal high yield bond indices. So our target is to outperform passive funds by 1.5% per annum after fees. And after 14 months, or if you allow me to use the end of September, which we don't have up here, we were more than 3% ahead after fees versus passive funds. So I hope none of you are invested in passive funds, but if you are, come and talk to me. And I'm fascinated to find out who it is that is investing in passive funds. So that concludes our presentation, but I think we're going to go and sit down on the comfortable-looking white chairs, and perhaps you can ask us any questions. If this was a UK audience, we wouldn't get any questions because everyone's too shy. But I'm hoping that a Maltese audience will be full of questions. So thank you very much.
We have some questions, which obviously I will ask David and Donald on your behalf. But obviously, if you have any other questions, please feel free to ask. So let's start off. One of the topical subjects, obviously, I don't want to start. Brexit, okay. So, David, how challenging in terms of the fund management? Although obviously you have your own personal views, but at the same time you need to manage such a big fund like the bond fund we've just heard about.
Yeah, that's a good question. I think it's very easy for fund managers to be sucked into expressing their personal views and desires in portfolios. So I'll be honest, I'm very much a pro-European. I think, quite frankly, I find the whole situation nonsense. Never mind the vote to leave by the 3 years since then. However, it's very important. I tell you, I'm just going to. It's very important to remove that what's in your heart, and remember, when you're managing money, it should be done with your head. And in all honesty, despite the mess that is Brexit, the opportunity that it creates for Donald in the high yield fund or me running some of the global funds is fantastic. So that volatility in the short term, we can exploit, hopefully to make some money for clients. People generally are quite scared of volatility, whether it's because of Brexit or whatever other reason. But as active managers, I think Donald would agree, as active managers compared with passive alternatives, volatility, if you don't like volatility as an active manager, or indeed perhaps as an investor, maybe you should look elsewhere. So certainly for us, Brexit, I say personally I have quite strong views, but it's very important not to let those dominate thinking in portfolios and to use the volatility as an opportunity to make money for clients. I'd say very briefly, so we have Donald and I also run a global strategic fund. Today has been a good day for us because there was a tentative agreement between the UK and Ireland, or certainly more positive than had been the case. So that was really bad news for the domestic UK bond market. And in our strategic fund, we have a short position, so we benefit when prices fall. And today, prices have fallen quite significantly. So for our investors, a good day using that volatility, exploiting that volatility to try to make some money for our clients.
Thank you, Another interesting question that we had is regarding the Maltese investor. Obviously, this is Malta, so we'd like you to tell us whether you observe any difference in terms of the outlook of the Maltese investor compared to the European or British investor.
It's a leading question. Well, Donald mentioned this in the presentation, and I think it's very true. So for maybe about 12 or 13 years now, most of the business that I have been developing has been outside of the UK. So with my previous company, we had clients in 21 countries, and I probably visited 25 or 26 seeking to raise assets. And there is a huge difference in how people think about markets and how they understand markets when you move from one jurisdiction to another. And certainly within Europe, there are 3 or 4 countries where I think the advisors and the people that they are advising understand the role of bonds and how they work much better than in the rest. And without putting a ranking to it, certainly the top 3 or 4 are Italy, Switzerland, Malta, and arguably Germany. And then the rest, certainly our domestic market, as Donald said, they find bonds very confusing. They don't really understand what they're supposed to do. And I think we know that the history with respect to pension provision in Malta. But certainly I think the awareness, the understanding of some of the detail of bonds and bond funds is materially greater here, which makes our role certainly at events like this or when we're thinking about managing portfolios much easier.
Donald, maybe no. Donald, one of the questions was, does your portfolio return come from capital or income? Obviously, maybe you can elaborate on what you presented already.
Yeah. So, I mean, the overwhelming returns... Oh.
Blue, the overwhelming returns.
Well, you remember the chart, I hope. Get through all the regulatory messages. So, as you can see, for the high yield market, the coupon. So you've got a portfolio full of companies paying an interest rate and then paying you your money back at the end. That's just all a bond is, a corporate bond. So you see the overwhelming return for the market has been income, and actually defaults have gradually eroded capital. Now, our experience, certainly for our fund in the last 18 months, has been the flexibility to increase and decrease risk at certain times of the market and completely ignore certain sectors like oil and gas, and well, maybe not completely ignore, but largely ignore, has either given us the ability to add capital or, more importantly, defend capital in the portfolio. So that boils down to it. That is why I think anyone should choose a stock-picking, flexible high-yield manager, not a passive fund, and not a fund that's got 300 bonds. As smart as the high-yield manager that comes along with 300 bonds in his portfolio may well be, the sheer size and number of bonds they have, I think, is an obstacle to them providing that either capital value or capital protection that a good, flexible, concentrated high-yield fund like ours can do. Now, of course, we can only grow so big. You know, if we took in $10 billion of AUM, there's no way we could run our portfolio the way we do it. But believe me, we will have closed the fund long before that becomes a problem, because we want to continue to manage our portfolios in 5 years' time exactly how we're managing them today.
Maybe on the same thing, Donald. As an investor, you know, hearing the latest news about the possible recession, you know, coming along, should they be worried if they're invested in your fund?
Everyone has a different appetite and understanding of the word risk. It can be just your personality. It can maybe more likely your age, stage in your own wealth creation. you have a different attitude towards risk. So there are undoubtedly people who maybe shouldn't be invested in the high yield asset class because a 5 to 10% capital drawdown may spook them and they may tell their advisor to sell the fund at that point. What I would say is, don't do that. The 12 months and 23 days in 2008-9, you're back in black. And that was the mother of all. You know, I don't think the next one. So if there is a recession coming, the way we see it, because we just think economies are slowing from a high base. We can't see that systemic crash. No one saw that last one coming, so hold our hands up on that. But we think this is a slowing down. So it's an earnings event. Company profits are going that way. But is it a balance sheet event? Is it an event that's going to lead to large-scale defaults? We don't think so. So right now, we are not taking extreme risks in the portfolio. We never do. We're keeping things quite tight in terms of the quality of companies that we're investing in. But we don't think our investors should be heading for the hills. They should continue to earn that income. And if we do see a 5% capital drawdown like we saw in December, then the next 12 months can provide a double-digit return like we've seen this year. So long-term investment, don't worry about a bit of volatility. Easy. But it's always easier said than done.
Donald, another question for you, David. A generic question. For how long do you think somebody should perhaps stay invested in a fund?
Again, I come back to Donald's point. To an extent, it depends on risk appetite and the asset class. But generally, we would say that a minimum of 3 years. We're not running hedge funds. We're not trading instruments every day. We're trying to build up over time, over years, potentially decades, a consistent level of total return. So, and with the flexibility we have, as Donald said, if there is a bad moment, then hopefully we can do something to enhance future returns. So definitely, I would say, not just for our funds, but for many of the public funds, the open funds in the market, people generally should think in terms of years. Importantly, though, is always your exit. So at some point, most people want to do something different with their money. Again, maybe it's leave it to a child or a grandchild, or buy a new house or a boat or a car. So for me, it's very important to realize that you are all at the mercy of that timing. Sometimes you need money for reasons that you didn't expect. So again, the more money you commit to an asset, class, particularly the higher risk it is, I would suggest the more you should value liquidity and your ability. If you give a fund manager money on a Monday, to take it out on a Tuesday is sometimes, I think, underrated, the ability to do that. So long term, certainly in terms of years, but we have to be realistic and realize sometimes we have a need to take money that we didn't expect. So ensure your fund manager has enough liquidity in their portfolio to allow you to get your money back.
One last question for you, David. You are obviously the manager. You mentioned in your introduction that you are the manager of the Strategic Bond Fund. You obviously believe in it. Are you actually, may I ask, are you actually invested in the same fund?
Well, I have to declare, so I'm 52 years old. So the Strategic Bond Fund that I manage is designed to provide a degree of excess return above inflation. So in normal times, we think that we can do maybe 5 or 6%. Just from the raw return in the market. Now, today, as I said in my little bit, we think bonds are very, very expensive. So a lot of the excess return we've made has been because we've found these weird little trades rather than following the market direction. But at my age and having worked in financial services for 30 years, fortunately, I've reached the stage where I don't, if I get a bit more wealth, that's great, but it's really about protection. So thankfully, the fund that I manage marries up very well with my personal requirements. So if I was 20, would I buy a lot of bonds? I'm not sure I would. So the simple answer to the question is yes, I'm invested, and the slightly more detailed answer is that I believe that certainly today I am still the largest private investor in the strategic fund. And I also have to say I do invest in Donald's in the high yield fund as well. So the very short answer is yes, but importantly that is because the strategy of the fund fits with my needs, and I think for any investor that's very, very important. A fund manager can talk the greatest story, but if it's not the story you should be listening to, don't listen.
Thank you, David. From my side, my last question is going to be addressed to James in terms of MeDirect are very proud to have helped in the high yield bond fund launch in June 2018. I'd like your impressions to tell the audience, please, about your impressions from the working relationships out of your association with MeDirect.
Good evening, ladies and gentlemen. I get the easy job of having the last question and then releasing you, hopefully, to your drinks, unless you have some more questions. To be honest, we were absolutely delighted when our, I'm going to call them colleagues here at MeDirect, got in touch with us when they realized that Liontrust had somehow miraculously managed to recruit David and his team from running a huge amount of money at another fund management company to come and join Liontrust. And we were absolutely delighted to be in touch with MeDirect to assist us in the launch of the high yield fund that Donald's described. I think I'm allowed to say this because I'm a sales guy. Donald's been incredibly modest. He's not shown his previous track record from the 10 years prior to joining Liontrust, which is absolutely phenomenal. And I do encourage you to just go online and look at that. You can do that. And to be invited by such a major player in the Maltese market to participate in really what is a kind of a joint venture with you for this product, we're absolutely delighted, to be frank. And we know that coming here, we know you can all buy local bonds that have pretty good yields, and you know the people involved in it. That's a great thing to do. We also think that global diversification at some point in your portfolio is an important thing, and hopefully we can help you with that. And when times get bad, because they will get bad, you know, there is bad news out there at some point. It might not be next year, it might be in 5 years' time. We will do our level best to make sure they're not quite as bad as where they might be in other parts of the market, and give you the liquidity that you require, because one day you will want that money back. So we're very, very happy to be here. It's always a delight to come to Malta, even though the waves last night were about 6 meters high outside my hotel window, making an enormous amount of noise, but it was rather thrilling to see that, and it's thrilling to be here. And there's a full room here tonight. We're very, very pleased to see this many people. And we're here for the duration of the evening. We're very happy to answer any further questions you may have about Liontrust as a business. It's a super dynamic place. We've got lovely fluffy lions. There's a few extra bags lying around, so anybody who has grandchildren, etc., just steal one. And don't worry about that. And thank you again to all of you, and to Ray, and to everybody at MeDirect for bringing us along.
So on behalf of the audience, obviously also MeDirect, I'd like to thank you again. David, Donald, James, thank you for your presence.